How to use a technical indicator when trading. Let's look at some common strategies. Make trends stand out, moving averages. MA, short for moving averages, averages a security's closing prices over a specific period. For example, a stock's 5-day moving average is calculated by dividing the sum of the closing prices for the last 5 days by 5. It represents the average trading price for the stock over the past 5 days. In real trading, we often use a single moving average to analyze the trend, which is called the moving average crossover strategy. A bullish crossover occurs when the stock price crosses the moving average to the upside, which indicates the trend might shift upward. A bearish crossover occurs when the stock price crosses the moving average to the downside, signaling a potential downtrend. You can also use a short-term MA, like a 5-day MA, and a long-term moving average, like a 20-day MA, together to measure market sentiment and identify entry signals. This is called the dual moving average crossover strategy. When a short-term average crosses over a long-term average to the upside, a golden cross occurs, which is a bullish signal. Conversely, the bearish death cross occurs when the short-term average trends down and crosses below the long-term average. But remember, moving averages only reflect past trends, and past performance is not indicative of future results. Other technical analysis tools should also be considered to analyze trends and make decisions. Technical indicators can help traders better understand potential trends and price changes. But it's worth noting that while technical indicators can be effective, they should not be relied upon exclusively when making trading decisions. Traders should take account of fundamental analysis and market sentiment before making any trades. Join Moomoo courses to learn more about technical indicators.